So I can't believe I'm going to say this with a straight face and actually mean it, but is Teladoc Health now a value stock after all this time? What is going on, investors? Hopefully you guys are doing well out there. If you remember my videos on Teladoc Health, they mirrored a little bit of our Intel videos and our Plug Power videos. I absolutely eviscerated this company and its investors for buying this company at market caps that were 10 times higher than where the stock is today. But now we've got just a $4.6 billion valuation on this one. The stock is down over 80% over the last year. And when we start walking through these financials, it is absolutely starting to turn the corner, and this is actually starting to look like a stock that maybe you can actually put your money into. Look, over the last year, again, down 80%, $4.6 billion valuation. That is on the heels of reporting their Q3 earnings last week on the 26th. Revenue came in at $611.4 million. Still 17% growth year over year, beat expectations on that revenue side by about $2.4 million. It beat expectations on kind of its GAAP earnings per share, although it's still losing money. We'll show that to you when we get over to the financials. This company's still losing money, but it's absolutely starting to turn the corner. We also got Q4 guidance, revenue expected to come between $625 and $640 million. You might be wondering, where does that line up with expectations? Well, it's basically right there. Average analyst estimate out of 22 on Wall Street coming in at about $632 million. Again, company expecting between right there, about 625 up to about 640. Net loss per share between a negative 10 cents and negative 40 cents. Wall Street expecting about right in the between that, right around about negative 18 cents. Now, here's the problem though with Teladoc Health. Basically, for the next 2 years forward, you are not going to make money, at least from a GAAP perspective, on this stock, but you are going to couple that with the fact that this company is likely going to achieve kind of that mid-teens grower in terms of its revenues, which if the company is able to achieve this kind of mid-teens growth, a lot of investors will probably look aside the fact that the losses from operations, while still there, are improving somewhat. Overall, from a guidance perspective, everything is starting to line up a little bit for Teladoc Health. Now let's come over here and look at these financials. We have that revenue of $611 million. Again, that was 17% higher than the year before when you were closer to $521 million. Now, what I also noticed that went up in the most recent quarter is your gross margins ticked up 1% or 2 over the previous period. So you have a little bit of margin expansion to go along with that revenue expansion. Those are both very, very good signs for this company. Now, unfortunately, everything else is going up from a cost basis as well. Your advertising costs went from 111 up to 178. Your sales and marketing actually went down just a little bit, but your technology and development went up a little bit. Your general administrative also up, but the company is starting to turn the corner from having to amortize its acquisition and integration cost with Livongo Help, which was just a complete disaster from a financial perspective. I'll go over that here in a second, just in case you haven't seen one of our previous videos. But those costs went down year over year. Those should roll over. You shouldn't see those anymore. And the company actually recognizes a large amount of depreciation and amortization on this. This is going to be a non-cash charge. So when you factor in over $683 million worth of total expenses, you get a loss from operations after you take your revenue minus your cost minus your expenses. You get a loss from operation in the most recent quarter at minus $71 million. And it's a slight increase over the previous period of about $60 million. But you factor in, out of this $71 million, $62 million is depreciation. Another, we'll call it $1.6 million, is from these acquisition costs, which shouldn't reoccur. And the company's pretty darn close to breaking even, again, minus depreciation and amortization. Now you stretch it out for the 9-month, and it's one of the most ugly things that you'll ever see, considering the company had to take a a goodwill impairment charge. This is for $9.6 billion, which is hard to say with a straight face because the total company is worth $4.6 billion. And on their financials over the last 9 months, they actually had to take a $9.6 billion impairment charge. This again is from that acquisition they made of Livongo Health. They bought that company essentially at the top of the COVID markets. And so they obviously grossly overpaid. And look, if you paid much more for Teladoc Health, if you're in this stock for a higher price, look, if those mistakes happen in the stock market. People pay too much for things, and that's what happens. And you probably paid too much for this stock, and obviously Teladoc paid too much for Livongo. So they have to recognize that on their financials. They have to clear that off of the balance sheet, clear that off the statement of operations. It's an ugly process. I've seen other companies go through this. Under Armour is probably another premium example. It's still not going to be a quick road back from that, but you do get to wipe this off. So it messes up your 9-month financials. The fact you have this $9.6 billion on here, but you strip that out and you take a look at the most recent quarter, and you're starting to see that this company, while not profitable, is getting towards that path. And I like the fact that their margins actually expanded in the most recent quarter. We flow down here to a statement of cash flows, probably gives you a better insight into this company's ability to maybe eventually churn out a GAAP profit. So you pull down that net loss, which is just a disaster in the most recent quarter at $9.8 billion. But understand, $9.6 billion is simply a goodwill impairment charge, kind of an overpaying for a Livongo Health charge, if you want to put it that way. You've got depreciation and amortization at $180 million. You have stock-based compensation, which is probably still a little excessive over at this company, but that's coming in at 167. You get to add all these things back in because there are non-cash charge, at least from operating the business, over the last 9 months. So you come down here, you do net cash provided by operating Teladoc Health, and it actually looks pretty good. $123 million worth of positive cash flow. Last year, it was at 110. So they're absolutely starting to turn the corner over at this company. Now, what we notice though with this company is, man, they have to invest a lot in this capitalized software. This is probably where the vast majority of this depreciation and amortization comes from. They capitalize the software here and then they depreciate it here. And in the most recent 9-month period, $108 million of capitalized software costs. You hope that at some point they don't have to invest so much into their software and it becomes like a Microsoft situation over here, or like an Adobe situation where they're not having to update this software so much. Obviously, they're not there yet, but probably the bull case argument is they eventually become like the Microsoft or the Adobe of this space, and they don't have to invest so much into the software, and they just hit a rebill on their customer every month. Last year was just $35 million. Capital expenditures much higher in the most recent 9-month to the tune of about $10.3 million. Last year, it was just $5.6 million. So despite having $123 million worth of positive cash flow from operating the business, you burn through most of that actually kind of reinvesting in the company. So in the most recent period, you did burn through some cash. As you flow down to the balance sheet, you see a little bit of evidence of that, but you really notice this goodwill. Okay, last year, at least in December, they had over $17 billion worth of total assets over at this company. Again, which is just remarkable considering the entire company is now worth $4.6 billion. I mean, we're talking about in December, it was nearly 4 times higher, at least from a balance sheet perspective. Now the company is recognizing about $8 billion worth of total assets. Not a ton of it is what I would call straight cash. You have about $900 million in cash, another $200 in receivables, and another $126 in prepaid expenses. Straight cash, you've got just under $1 billion. Notice that goodwill, that's basically valuing the Livongo acquisition. They had to write off about $10 billion of that, as you were at 14.5 in the beginning of the year, now all the way down to $4.8 billion. Who knows? they might have to take another write down in subsequent quarters, in subsequent fiscal years, but likely the worst is over when it comes to those types of write down. From a liability perspective, not a whole lot here, other than you do have a convertible note sitting here, so there could be some more dilution coming down the road with Livongo and Teladoc. But overall, the company has gotten itself in a much better financial situation. They do generate positive cash flows that will help them reinvest that into software and capital expenditures. And when we're looking at a $4 billion valuation or nearly $5 billion valuation on a company that is generating comfortably $650, $700, nearly $800 million in future quarters in quarterly revenue and growing them very steadily, kind of in a mid-teens fashion, well, all of a sudden you finally have a stock that is not as wildly overvalued as it once was. Now, from a technical perspective, still has not broken out and still doesn't show a clear sign of a bottom. We're in this obvious downward channel with this stock. It is not broken out over it. So we zoom in here in the most recent price action, and we're sitting now at the top of the channel. And those of you that have been following this channel for any length of time understand, look, over the last couple of months, when a stock is at the top of the channel, it almost immediately gets rejected and pushed to the bottom. It doesn't matter if it's Amazon or Nvidia. I could see taking a flyer on this one. Now, the other scenario that could happen is the momentum stays in these market. The stocks like this certainly are completely oversold, and we get a little bit of a rally pushing us over this trend line. That would be a pretty bullish move, but you should meet some resistance here at this red line at about $37 per share, $36 per share, plus or minus a couple of dollars. That is why I wouldn't necessarily recommend running out and getting this stock right now, because yes, the momentum can carry into next week, next month even, but you get up here to about 35, just $5 higher on this one, and the seller should materialize, and then you should get another subsequent pullback, probably back testing this upper trend line. That would ultimately be the area that I step in. So if you like Teladoc, if you're in this one at a higher price and you don't know what to do, the first thing is to recognize that you need to take profit in these types of stocks, especially if you bought this one over $80, $90, $100 per share. You just can't let a stock go from $100, $200 per share all the way down to 30. You just can't let it do that. I don't care what the stock is. So take this as a lesson that you can't do this. If you are in this one between, call it $50 and $80, and you still believe in the long-term future, certainly as we walk through these financials, there's absolutely some reasons to believe that. These are the areas where I would go ahead and dollar cost average into this. Again, we're waiting for this one to either get rejected here at 30. It should happen like next week. You should get rejected, pull down to the bottom of the channel. Should take you south of about $20 on this one. That's where I would add. Otherwise, you could have a push up to 35 and then a back test to the top of the channel. That should take you again right in that, probably not necessarily south of 20, but I could see this one getting back to 20. Again, that's also where I would look at adding this one. You've got a little bit of margin of safety. The fact that the valuation has completely drained out of this one, it's offset a little bit by the fact the company is not expected to generate an operating profit really into the future, but that is offset in itself by the fact you've got a nice mid-teens grower here, and I actually can believe that it will achieve these mid-teens growth targets, and it's a steady business, not one that's lumpy or susceptible to different seasons or different economic conditions. And there's always the argument that this stock could be bought out, as it has some assets, it has cash flow, and it's actually the combination of two stocks, both Livongo and Teladoc. I could absolutely see an Amazon or a much larger healthcare player out there spitting off $5, $6, $7, $8 billion and making an acquisition. So there's a theoretical floor underneath this stock. I would guess it's somewhere kind of in that south of $20. That's why if it gets down to that level, certainly could be an interesting speculative play, given that it would be an acquisition target at those levels. Hopefully you guys enjoyed today's video. Nice not to completely obliterate this stock. What you really got to do if you were sold on this stock at a higher price, you need to question if that was good advice and if that's someone that is worth listening to. I destroyed this stock when it was up over $100 per share. And now that it's down at 29, I'm kind of falling in love. Hopefully you guys enjoyed today's video. Back again soon with more. Good luck with your investments.